How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss with you what's an annuity and do a full review on this because there's a lot of misconceptions out there. A lot of it is actually justified regarding whether annuity is really bad or can be really good. So I want to kind of decipher the different types of annuities and then go over the pros and cons of each so that you guys could be fully equipped to decide whether or not a portion of your retirement savings should be placed into an annuity contract. Now, an annuity is pretty much that. It's a type of insurance contract that prevents an individual from living too long. So with life insurance, what a person does is a person purchases, they put premium payments either on a monthly, quarterly, semi-annually, or annual basis in with an insurance company, and then that insurance company is protecting that individual's life to say, okay, if you pass away in a week or if you pass away in 50 years, we're going to pay your beneficiaries a lump sum as if you were still there, as if you could provide for them financially, to make that individual whole, to make your beneficiaries whole. So it's not supposed to make the individual rich or make their beneficiaries rich, but it just leaves a legacy for those beneficiaries. Let's say if this person had like a 30-year mortgage, well, then they'd usually get like a 30-year term life insurance policy to make sure that, God forbid, if they passed away, the spouse could now pay off the house and they don't have to worry about that financial burden, as an example. With an annuity contract, it's the exact opposite. What's happening is an individual is taking a lump sum of dollars. They're placing that with an insurance company, and the insurance company is doing an actuarial, is placing this person in actuarial data to say, okay, based upon this lump sum dollar amount, we project that this person is going to live till age 85 or 87 or 90. So we will, with a portion of interest and income, we will provide them a level income stream for the rest of their life. So let's say if somebody had $100,000 and they threw that in with an annuity contract and they were 65 years old, and this company, what is called company XYZ, says, okay, you're 65 years old, you gave us $100,000, we're going to provide you $7,000 to the day that you pass away. If you pass away after the first month, we keep that net profit of $93,000. If, let's say, you passed away in 50 years, well, now this individual is winning because that insurance company is still paying them $7,000, $7,000, $7,000, as if you think of this kind of like a retirement bucket, if they were to siphon through $7,000, they would have a specific break-even point well before that 20-year mark. So it gives that individual the peace of mind that they don't have to worry about outliving their retirement savings because they have that specific contractual guarantee through the insurance company, through the claims paying ability of the insurance company to make sure that they're paying them that set income stream. So from the insurance company's perspective, they're taking those dollars and millions of other individuals that are placed their money into that insurance company. They're investing on the back end. They're utilizing their hundreds of years of actuarial data to bring back what would be profitable on the insurance company standpoint, and then what would be a good incentive for the individual to place their dollars with that company. So that's the very generic shell of how an annuity works. Is an individual is placing a lump sum, the insurance company is providing them back an income stream that individual cannot outlive. So you had the first type of annuities out there were immediate annuities. And it works very similar to how a pension plan works. You could have an immediate single life income option. You could have a joint life income option. You could have a period certain income option. I'm just going to keep it simple with this video, single and joint life. So what that says is exactly like my example, an individual 65 years old, and they're giving $100,000 to the insurance company, and the insurance company says, okay, you're a male, age 65, we're going to provide you $7,000 per year of lifetime income that you could never outlive. If, let's say, this person put it into an immediate annuity and them and their spouse were both 65, well, now that insurance company is covering two lives, they're covering joint. So after the second spouse passes away, that's when the payments are going to stop. Maybe this will now be $5,000. So there's going to be a $2,000 difference, or at least a more significant of a difference, because obviously there's a larger risk to the insurance company, so that insurance company is going to give less of a guarantee to those individuals. The problem with this, and probably when you're hearing this, you say, well, that sucks. What happens if somebody, goes and only lives for like 2 years and then dies? Well, that's the problem with a lot of these immediate annuity contracts. That's the problem with a term known as annuitization, And this is what insurance companies love, is they want to essentially bait and switch. They want to essentially sucker somebody into a contract, force them into annuitization so that now they control the chips, they control all the different terms of that contract. So in earlier years, an immediate annuity could still serve its purpose. And kind of like when I explained on the pension side, like a pension maximization, you can do an immediate annuity maximization. It's known as an arbitrage strategy. What I mean by that is, like, let's say if somebody goes and they had, and we're just going to use easy numbers. Let's say that you have a male age 65 and they're throwing in $100,000, and we're going to say that the insurance company is giving them $10,000 just for really easy math. Or if them and their spouse, let's say their spouse is currently age 62, they gave that same $100,000 and they're saying, okay, single life income for just that male would be $10,000 of lifetime income, but joint is going to be $5,000 of lifetime income per year. That's a $5,000 difference. So a really quick fix on an immediate annuity that you could maximize out that sort of process is this individual could set it up on a single life income option. If he is insurable, he could also use a couple of grand, let's call it $2,000, to purchase a life insurance policy known as a GUL policy. So it's like a permanent life insurance policy without any cash value that will bring him all the way to like age 121 or age 120, something that he knows he's not going to outlive. And that might provide an additional, $200,000 of a tax-free death benefit. So what happens is they would put the $100,000 with that company. They're getting paid $10,000. This individual or this couple is using $2,000 to now cover a $200,000 death benefit for that individual, and now they're netting $8,000 as opposed to only netting $5,000 if they went to that single life only option. If this person was to pass away, yes, the insurance company keeps the remaining of the money, but now $200,000 of a tax-free death benefit goes to the spouse, and now she gets to either place it into a new immediate annuity or basically live off of that $200,000. So it's basically just leveraging your chips the right way to make sure that you're getting the maximized benefit. I personally don't like immediate annuities. I think that there's hybrid annuities that give you a lot better control. But insurance companies, they absolutely love immediate annuities because they're forced into that annuitization option. They're forcing the client into that annuitization option of saying, okay, you pass away after a couple of years, we get to keep the remainder. Tough luck. Or that was the risk that you chose for getting set up into that type of contract. There's another type of annuity out there known as a DIA, a deferred income annuity. Immediate annuities work where you have to trigger that within the first 30 days to about a year. So it has to be triggered immediately. A deferred income annuity might be something of, they're known as DIAs. I hate these as well. I actually hate this more than an immediate annuity. Some insurance specialists out there or advisors out there try to really hone in on this DIA. It's because it gives a nice commission, and I just think it ends up screwing the person with losing control. But essentially what happens is, let's say if you have an individual that's age 60 and they're putting $100,000 into a DIA and they understand that they're not going to trigger their income till age 65. Well, maybe because they're surrendering their rights at age 60, by age 65 they're guaranteed $11,000 of lifetime income. So all it's saying is we're losing control for exactly 5 years. We can't dip back into our account. And there are certain provisions that you might be able to, but understand you're better off with just being set up into a better annuity contract where you don't have to lose all that control. You don't have to lose all that leverage to the insurance company. And then that's providing lifetime income from that standpoint. So it just kind of gives them a couple of more years. That's why they're providing that individual with a higher rate of return, a higher income stream, is because that individual is taking on a higher amount of risk. So automatically think that the immediate annuity is you're annuitizing those contracts immediately. A DIA is you're annuitizing those contracts with a deferred growth. Possibly, is most likely going to give you a better income stream, but it might not be that favorable. So you had innovations of annuity contracts. Many times I talk to the individual that's in their 60s or 70s and say, oh, I heard annuities are crap. Well, it really depends upon which annuity contract you got set up in or which one you were looking at, because there's typically about 1,200 plus different annuity contracts per state. And that correlates to immediate annuities, deferred income annuities, fixed annuities, fixed indexed annuities, variable annuities, and then you have hybrid annuities. So the fixed annuity tries to combat like a bank CD. So what happens is a bank CD obviously has to be offered through a bank as FDIC protection. Insurance companies are very, very safe, and they have their own tiers of safety with fixed annuities. And what they do is, like, typically if somebody has $100,000 and they're getting set up in like a 3-year bank CD, and let's say that bank CD is paying them 1%, usually a fixed annuity, $100,000 into a 3-year fixed annuity would give them a rate of return of, let's say, 2% or 3% per year. So it just gives them a better bucket, and they're still using a very safe entity to do so. With a fixed annuity. So there's different ways that you could do laddering strategies where you could have like a 3-year product, a 5-year product, or a 1-year, 2-year, 3-year, 4-year, 5-year, and you just keep rolling it over to a 5-year product so that you eventually have the highest interest rates. What I mean by that is the longer time frame that you lock your money up, the higher this interest credit is going to be, or typically the higher that contractual guarantee is going to be. And there's a couple of really nice sweet spots with fixed annuities. So don't just go to the random company. If you saw, a television commercial, it really depends upon which week, which month that you're looking at those things, on which one's going to give you the best possible leverage if you're looking to just kind of throw it in there as your safe monies. A fixed annuity does have an annuitization option. All annuities have that annuitization option, but typically fixed annuities act like a bucket with a lid over it. This person's throwing $100,000 with the insurance company for X amount of time frame. They're going to be receiving a fixed interest credit. So it's as if they're opening up the lid, pouring that 3% gain inside. Open up the lid, pouring that 3% gain inside. Each and every year, they could pull out interest. They could pull out up to 10%. They have more liquidity options, as a regular bank CD does not allow you to have those liquidity options. And typically, it's about 2 to 3% higher than what a bank CD is paying with the current interest rate environment. A regular fixed index annuity, not a hybrid annuity, but just a FIA, works very similar to a fixed annuity, with that bucket with the lid over it, except for, like, if we have an example, let's say you had a 10-year fixed annuity that was paying 4%, and then you had a 10-year fixed index annuity, and let's say you had a cap of 10%, what exactly is the difference here? Well, with the fixed annuity, we understand this is like a bucket, and let's say this person gave $100,000. This is like a bucket with the lid over it. So each year, if the market goes up, the fixed annuity is going to pay them 4%. The market goes down, the fixed annuity is going to pay them 4%. There's no change there. With a fixed index annuity, let's say if you have a cap rate of 10%, a floor rate of 0%, what this says is, dependent upon the indexes that you choose with that specific carrier, if there's a gain with that index, you're going to have a gain into your account. If there's a loss in that index, you're going to have a gain of 0% into your account. So it's either going to gain up to that cap or gain 0%. So, like, let's say if you had a fixed index annuity with a 10% cap that was tied to the S&P 500, and let's say that the S&P 500 gained 15% the first year, then lost 50%, then it gained 5%, then it gained 7%, then it gained, then it lost, another 30%. What exactly happened? Well, we understand with the fixed annuity, you're always gaining that 4% for those 5 years. The fixed index annuity, with this hypothetical example, you'd have a plus 10% gain the first year, plus 0% gain the second year, plus 5% gain the third year, plus 7% gain the fourth year, and then plus 0% gain the fifth year. So essentially, you would have a plus 22% gain total throughout those 5 years. Into that account, as opposed to the fixed annuity, which would have given you, a plus 20% gain if you would have remained consistent with that account. So it just kind of gives you a little bit more of a risk, but with that safety net of saying that it can never fall below 0%. There are no advisor fees. There are no rider fees set up with a regular fixed index annuity, and that's essentially how that works. A variable annuity works very similar, except for you have uncapped growth, but you have uncapped losses as well, meaning that if the market does really well, and let's say it gains 15%, well, your variable annuity could have that plus 15% credit, but then that next year when it loses 50%, you could have that minus 50%. Variable annuities I do not like. There's a lot of hidden fees. They have a prospectus that is over like 300 pages that explains each one of those fees, and I just think that it's a typical bait and switch with insurance companies. Variable annuities used to be very favorable in early to mid 2000, like about 2000, 2001, 2005, they were pretty good, and then they've really gone by the wayside, where the FIA space has really taken over the annuity space for individuals that want to have that safe, consistent growth. And the very last type of annuity is one that I like to use a lot with retirement planning, and it's a hybrid annuity. In particular, you have a hybrid annuity either through a variable annuity with an income rider or a fixed index annuity with an income rider. I don't like the variable annuities with an income rider. I like the FIA hybrid annuities. And what this does is it combats that worry that seniors have with annuitization, with those immediate annuities, with that deferred income annuities, the DIAs, where you're losing control. What happens with the hybrid annuity is it's going to give your physical money that component of a bucket with the lid over it that's going to be linked to a stock market index, but you have something known as an income base or a calculation account that's going to determine how much lifetime income you're able to receive from the company. And make sure that as you're receiving lifetime income and you were to pass away, rather than all of your account value go directly to the insurance company, that account value could go directly to your beneficiaries. So whatever you do not use, you do not lose. You could go directly to, go directly to your beneficiaries. On top of it, if you ever came to like an oh my gosh moment, you could pull out typically up to 10% of that account value within that course of, if you were like in a 10-year contract, you'd be restricted liquidity for those first 10 years. After those 10 years, then you'd have full access to your monies. So it just works really, really well on an income standpoint. If I'm comparing it to a DIA, let's say with the DIA, we put $100,000 for that male age 60, and we say he's going to trigger income at age 65, and he was going to be receiving $11,000. Just as a really easy example. With that specific type of case, we understand that when they set up that DIA, they lost full control. They can't access their monies. If they pass away before 65, the way typically if you're trying to get a maxed out benefit on the DIA, that $100,000 is going to go back to the company. If let's say they trigger the first income payment of $11,000 and then they pass away, then that remaining amount is going to go back to the insurance company. You're losing full control on that. When we're reversing a hybrid annuity with that, we have $100,000. We're putting that at age 60. Want to trigger income at age 65. You're not annuitizing that to trigger the income. You're using the income rider. Typically, those income riders come with a cost anywhere from about 0.50% per year to right around like 1.25% per year. So right around a little less than 1%. And what this says is maybe at age 65, this individual is going to be able to receive $10,000 of income, but they get to have full control. This account value, they're able to control that. They're able to grow that account value with upward market movements and no downward market losses. The only negative that's coming out is that income rider fee. And the income rider is justified because that's what's going to provide this person a lifetime income stream of that $10,000. So let's say if they keep living and living and living and living and living, and let's say they reduce this bucket all the way down to $0, well, the insurance company is still on the hook to pay them that $10,000. So if they trigger this at age 65, and let's say they passed away when they were like 105 years old, that insurance company was still paying them $10,000 each and every year, even though their account value would have been completely exhausted, at that point in time. So it's very, very powerful. You could utilize that a bunch of different ways for income gaps. What I mean by that, let's say that an individual has like a cash account. They just sold a business, or they just sold a house. They have a cash account of about $300,000. Maybe they have a 401k account of another, $300,000, we'll call it. Well, this person could now they can set up two separate annuities depending upon what their income stream is. Most likely one of these would be able to suffice what that income goal is. But typically with retirement, you want to make sure three different things are covered. You want to make sure that you have sufficient amount of income streams coming to you. You want to make sure that you have ample amount of emergency funds. And then you want to make sure that you have a plan set up to combat any sort of inflation. So if we have an individual that's age 60, wants to retire at age 65, at age 60, and they need exactly $60,000 of income, at age 65, maybe they're receiving, $35,000 of Social Security income, and they have a gap of 25 grand. So out of that, maybe that 25,000, they could place 300 grand of their 401k into a type of annuity contract, an IRA annuity contract that will provide them a lifetime income stream of that extra 25,000 right when they hit age 65. So that's a 5-year deferred contract that will give them $25,000. Now this remaining cash dollars, they could leave, 6 to 12 months of their annual expenses into emergency funds. So maybe leave about, 60 grand, or we'll call it $50,000, leave that in just a regular, money market account, a savings account, so that they could pull from in case they ever came to an oh my gosh moment. And then this inflationary protection, they could do this a couple different ways. They could set up annuity laddering strategies where you might have a portion of this 300 of the 250 remaining. A portion of that might go into like a 7-year deferred annuity, a 9-year deferred annuity, 11-year deferred annuity, so that you're having these micro step-ups when your cost of goods and services are increasing from that initial $60,000 goal. Obviously there's going to be some fixed expenses and there's going to be inflationary expenses. How do you combat that inflationary expenses? So you can set up annuity laddering strategies. Or let's say you just want to have a more conservative growth strategy and you're not interested in income. Well, then that's where the fixed annuities and then the FIAs could work really, really well for an individual situation. There's some really good contracts out there in today's age on that growth strategy. So a whole slew of different options. The most important thing is to understand what an annuity could possibly do for you and how to avoid the mistakes that are made. Too often individuals just go into a random company. They talk to one advisor. They said at a seminar that advisors pitching one annuity, and that is completely the wrong way to do it. What I mean by that is, like I mentioned, you have 1,200 plus different types of annuity contracts. The chances that that one annuity contract that advisor is talking about at a seminar is the right one for your situation is going to be very slim to none. That's what we try to help out with. Is you could give us a call 24 hours a day, 7 days a week at our 1-800 number, 1-800-566-1002. When calling in, you'll ask to speak to a specialist. You say that you watched the video online regarding annuities and you had further questions on that. And then what's going to happen is that assistant's going to patch you over to that specialist. The specialist is going to ask you a slew of questions. Okay, what's your situation? What's your current retirement goals? All that stuff. If you're completely fine, if your path right now, if your plan is set up properly, we're going to tell you do not change a thing. If there are some different ways that you could leverage an annuity contract or different types of tweaks that you could make to your plan, well, then we might give you those recommendations. We're A+ rated on the Better Business Bureau. We try to go through a very methodical process of educating first, making sure that we're sending you personalized videos, PDFs, different things, literature pieces to make sure that you are fully acclimated, and it has to be a form of complete transparency between the advisor and between the client. So that's why we do not move forward until you understand the basics of everything. And that's what we try to do, is just make sure that you're educated and then you're confident with your decision. You see exactly what would be the best results. We're an independent agency, so we're not going to be biased over one company over the next, as opposed to some of the other captive agencies out there. But yeah, once again, I want to thank you very much for watching this video, and please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.